Vertical Man Pictures presents the Forex video training series. Black Belt Second Degree Trade Guide to the Major Economies, Eurozone. The European Union, EU, is a brotherhood of 27 member states, which started from a tiny gang of 6 neighboring states in 1951. By the magical powers of Treaty of Maastricht, it then grew into a large economic and political bloc, making it the largest economic region in the world. Talk about playing a huge role in international trade and economic affairs. Among these EU member states, 16 countries adopted the euro, EUR, as their common currency. These nations comprise the Eurozone, which are also called the European Monetary Union, or Euroland. Members of this elite club are Austria, Belgium, Cyprus, Finland, France, Germany, Greece, Ireland, Italy, Luxembourg, Malta, the Netherlands, Portugal, Slovakia, Slovenia, and Spain. Aside from adopting a common currency, these nations also share the same monetary policy set by the European Central Bank. Here are just some facts and figures for you to mull over. The economic overview. The Eurozone, which comprises more than half the nations in the EU, serves as the second largest economy with a GDP of 8.7 trillion in 2009. Being a services-oriented economy, services account for a whopping 70% of its GDP. On top of that, the Eurozone takes pride in being the second most attractive investment market for domestic and international investors. As an economic union, the Eurozone has a standardized system of laws, particularly for trade. The size of their entire economy makes the Eurozone a major player in international trade arena. Because if individual countries are grouped as one entity, it enables them to facilitate trade easier, mostly with its number one trade partner, the United States. This active participation in international trade has a significant impact on the role of the euro as a reserve currency. This is because countries who transact with the Eurozone need to have a significant amount of reserve currencies in order to reduce exchange rate and minimize transaction costs. The European Central Bank, ECB, acts as the governing body for the monetary policy of the EU, led by the current ECB president, Jean-Claude Trichet. The executive board also consists of ECB vice president and 4 other policymakers. Along with the top guns from the national central banks with the Eurozone, they make up the ECB governing council who vote on monetary policy changes. The main objective of the ECB is to stabilize price in the entire region. That's quite a tall order. To achieve this goal, the Eurozone signal must applies a certain number of criteria for the member nations. Here are some of the requirements. The nation's inflation rate must not exceed the average inflation of the 3 best performing lowest inflation rate states by more than 1.5%. Their long-term interest rates must not exceed the average rates of these low inflation states by more than 2%. Exchange rates must stay within the range of the exchange rate mechanism for at least a couple of years. The government deficit must be less than 3% of the GDP. If a nation fails to meet these conditions, they are penalized with a hefty fine. Yikes! The ECB also makes use of the minimum bid rate and open market operations as their monetary policy tools. The ECB minimum bid rate, or repo rate, is the rate of return the central banks offer to the central banks of its member states. They make use of this repo rate to control inflation. Open market operations, on the other hand, are used to manage interest rates, control liquidity, and establish monetary policy stance. Such operations are conducted through buying and selling of government securities on the market. In order to increase liquidity, the ECB buys securities and pays with euros, which it gets circulated. Conversely, to mop up excess, the ECB sells securities in exchange for euros. Other than making use of the monetary policy tools, the ECB cannot intervene in the foreign exchange market to further cap inflation. Because of this, traders pay close attention to comments from the governing council members, since this could impact the euro. Aside from being dubbed the anti-dollar, The euro is also nicknamed the fibber. Some say that this nickname was a turn from the transatlantic fiber optic, which is used for communication, but some say that it was paper used to print European banknotes way back then. Here are some of the other characteristics. With the euro popularly known as the anti-dollar, the euro-dollar is the most actively traded currency pair. As such, it is also the most liquid of the major pairs and offers the lowest pip spread. The euro is most active during the 8 a.m. GMT at the beginning of the London session. It often has little movement during the later half of the U.S. session, around 5 p.m. GMT. The euro-dollar is often linked to the movement of capital markets, such as the bonds and equities. It is negatively correlated to the movement of the S&P 500, which represents the performance of the U.S. stock market. The correlation was thrown out of sync after 2007 financial crisis, though. Now, euro-dollar has a slightly positive correlation with the S&P 500. The euro-dollar also negatively correlated with the dollar Swissy, reflecting how the Swissy moves in almost perfect tandem with the euro. Some important economic indicators. Gross domestic product. The gross domestic product is a central measure of economic growth in the region. Since Germany is the largest economy in the Eurozone, its GDP tends to move the euro the most. Employment change. The euro is also sensitive to changes in employment, particularly in the Eurozone's largest economies like Germany and France. German industrial production. This measures the change in volume of output from Germany's manufacturing, mining, and quarrying industries. Because of this, it reflects the short-term strength of the German industrial activity. The German IFO Business Climate Survey. This is one of the country's key business surveys. Conducted monthly, this takes into account the current business situation of Germany as well as expectations for future considerations. Budget deficits. Recall that one of the criteria of the Maastricht Treaty requires that the Eurozone economies keep their debt-to-GDP ratio between 60% and their deficit less than 3% of its annual GDP. Failure to achieve these targets could result in fiscal instability in the Eurozone. Consumer Price Index. Since one of the goals of the ECB is to maintain price stability, they keep an eye on inflation indicators such as the CPI. If the annual CPI deviates from the central bank's target, the ECB could make use of monetary policy tools to keep inflation in check. Reports of strong economic performance by Eurozone as a whole or by its member nations can boost the euro higher. For instance, better than expected GDP reports from Germany or France could encourage traders to be bullish on the euro. Sudden changes in market sentiment, buoyed mostly by U.S. economic data, tend to have huge impact on the euro-dollar. Being considered the anti-dollar, the euro is also swayed by talks of reserve diversification away from the U.S. dollar. Euro as the new reserve currency, anyone? The bond spread between 10-year U.S. government bonds and the 10-year bunds, German bonds, usually indicate the direction of the euro-dollar. If the difference between the yields of the U.S. bonds and bunds widen, euro-U.S. dollar moves in favor of the currency with the higher yield. Similar to bond yields, interest rate differentials also serve as an excellent indicator for the euro-dollar movement. For instance, traders usually compare the Euribor futures rate with the euro-dollar futures rate. Just to clear things up, Euribor stands for Euro Interbank Offer Rate, which is the rate Eurozone banks use for interbank relations, while euro-dollars are deposits denominated in U.S. dollars. Some trading tactics. Pro-euro moves, which typically take place upon the release of strong economic figures from the Eurozone, create opportunities for long euro-dollar trades. Anti-euro moves, which typically occur when weak Eurozone economic reports are released, provide the basis for short euro-dollar trades. Since euro-dollar acts as a measure of traders' view on the U.S. dollar, sensing the direction of the U.S. dollar could create some trade strategies for euro-dollar. For example, if traders expected to buy the dollar if the U.S. retail sales report prints better than expected results, you could look for an opportunity to short euro-dollar. Aside from waiting for euro-dollar pair to retest or break significant support and resistance levels, taking a trade based on retracements also works for the pair. Let me say that again. Aside for waiting for euro-dollar pair to retest or break significant support or resistance levels, taking a trade based off retracements works for the pair. Euro-dollar is highly susceptible to retracements, which means that setting short or long orders at significant Fibonacci levels could yield some pips. By catching retracements, one may be able to enter the trade at a better place than simply jumping in the direction of the price movement. If you're a little more adventurous, there are other euro pairs such as the euro-yen, euro-swissy, and euro-pound that you can check out. Each euro cross has cool and unique characteristics as well. For instance, the euro-yen, which is more volatile than the US dollar, tends to be most active during the Asian and London trading sessions. Euro-pound and euro-swissy tends to be range-bound most of the time. The latter is more prone to large spikes, though, due to lower levels of liquidity. So if you're planning to trade in the euro pairs, don't miss on economic updates on the Eurozone.